Thanks so much for joining us. Individual sectors which are stressed, trying to put the pieces together to say that, okay, let the economy not worsen any further. Is that the way to see it?
Yes, I think, Ira, the first thing that we note is that the government has begun to address the supply side of the issues that were staring at us, particularly on, removing the constraints to improve the credit flows, the fund flows, and so on. So today's set of measures, I would believe, are more addressing comprehensively, to the extent possible in the first round, the supply side of issues. One is, of course, the three key immediate positives would be the removal of surcharge, the bank recapitalization to get front loaded. So I think, auto, of course, they've tried to enhance demand, as Mr. Bhargav was also saying, that, the whole lifting of the ban of the purchases of cars by the government. More importantly, I think increasing the depreciation, which renders a car completely, ready for next round is within 3 years. Earlier, it was 5 years. So that itself would also bring in some demand, as was being earlier said, once a more detailed scrappage policies taken on board, that would also. And lastly, the assurance that through the deferment of the BS4 vehicles up to March 2020, and also the registration being deferred right up to June 2020, all these are demand enhancing measures for the auto sector. But to a large set, a comprehensive set of supply side constraints getting eased, let's not forget that we do not have completely unlimited recourse to the stimulus in terms of outright cash injection than what has been announced in the budget, currently at government's disposal, particularly when the revenue has been slow to come by the time we still close the first half of the year. So it was important for the government to listen on the ground what were the constraints that were limiting the flows, and that is what has been a very, very positive development today, that this appears to be the finance minister has taken seriously all the concerns on board and has begun to address this. As I said, the near upfront first set of measures that we believe will bring in some growth kicker should be the PSU recapitalization, the quick clearing of the GST refunds through the MSMEs to the MSMEs, and also improving the sentiment through the FPI route. A 3.3 billion outflow since budget on equity side was clearly getting to be a point of concern, and all these seem to be getting addressed with the promise of more to come. I think there has been a pleasant surprise as compared to the past, where expectations used to typically ride much higher than the actual delivered promises. But today has been a different day. We've seen a set of measures which actually come closer to the expectations that seemed on hindsight running ahead.
Shubhada, two quick questions. So, both the Reserve Bank of India and the government now, and even in the budget actually, seem to be banking on this let's revive credit flow to actually get the economy growing. And in that, it's not just the quantum of money flowing to the economy, but also the price of money flowing to the economy. Do those measures taken together do anything, you think?
Absolutely.
Because this external benchmarking, I still want to see it see how it plays out on the ground before saying, yay, we've got better transmission.
Yes. No, true, absolutely. It's work in progress. We need to see how it actually translates into a higher improved demand. But it's a beginning that, linking it to repo rate, particularly the consumption of personal loans, that it brings to effect the cost of these purchases lower is a beginning. But as I said, this is one part of measures. The bigger issue is how do you put money into the hands of people to buoy and boost the demand side of story, and that is something which is going to be a longer playing story, because we need to see all those cash transfers, all the rural economy monies that have been promised to see the light of the day in earlier part of the FY20, so that some demand is more visible, particularly starting the festive season, October, December. So I would say, Ida, that these coming 40 days are going to be very, very critical as to how both the demand side and the supply side are fashioned to bring in growth, at least in the H2 of the fiscal year. Remember, the first half is nearly significant slowing of growth momentum from 5.8 of the previous quarter. The first quarter we are penciling in a 5.5% growth of GDP. The second quarter is not likely to have any significant upside, so it leaves a lot of hope and expectations towards the second half of the year, which, if the government really does deliver on these measures over the next 30 to 40 days, I would think there would be at least an arrest of the expectation of a continuing downturn or downdraft in terms of growth momentum. But having said, I think most of us analysts have looked to revise our GDP much lower. In fact, in our earlier show with you on the Monetary Policy Day, we did say that RBI's 6.9 GDP for the year looks a little tad ambitious, and we were all in the process of marking down because of the first half of a fairly concerning slowdown of the economic momentum. So 40 days and then we are all set. Monsoon has been positive. Oil has once again become a more supportive factor. If the consumption loans continue to get lower, that will to some extent help the demand side. But we would all be looking more closely as to how these measures on the ground translate into some high frequency numbers over the next 40 days.